Hey everybody, Tom Gentile. Glad to have you back for week number 2, October 21st, 2020. Glad to have you all here. We have got a lot to cover here in the next hour, I guess we'll take for this particular webinar. Let's get through the housekeeping first. Starting off with the sessions being recorded. We'll get it out to you guys. It'll be out sometime tomorrow, all right? And so give me a little time as we get that set up and sent out to you. Second thing I'm going to mention real quick is that this disclaimer you see on the screen, you can stop it anytime during the recording and read it in its entirety. I'm going to mention 2 quick things before we begin. Number 1, stock and options trading has large potential rewards, but also large potential risk. And number 2, myself, Jay Harris, who's with me tonight, anybody else who's on our program, and we do have a special guest coming in next week. We are here as educators to show you how it is that we trade and navigate the markets. We're not investment advisors. We do not give specific trading advice. And everything I'm going to talk about is in US dollars unless noted otherwise. Tonight, we're going to do a quick review. We're going to get into spread trading. We're also going to get into trading contrarian patterns with our Darknet strategy. Again, next week we'll do a quick review and we're going to talk about advanced charting. So make sure that you're here next week for that. It's going to be a great session. Jay, did you see what Bitcoin did today?
Oh, baby.
I don't know. I mean, you know, I put out a video on Monday, and that was on our YouTube channel. In fact, if you guys take a look at the chat box, you'll see I have a little link to it. Latest video on Bitcoin, where my long-term is on it. You won't believe it till you see it. What I expect Bitcoin to do in the long term.
That was some good PayPal news, huh?
It's a crazy, yeah. I didn't know PayPal. I didn't know what was coming out today. But hey, that just helps add to what we already see, which is a dwindling supply and more demand. So, you know, something we can get into at a later time. But if you guys want to find out more about that, then check out our YouTube video, youtube.com/Tom's Trading Room. Click on the link there in the chat box. I also sent it via an answer to a question to all of you. So you can view that in your own time. You know, we discussed this 3-legged stool here of trading where we talk about spotting opportunities, what we call rules-based opportunities, creating low-risk trades, and then plan, execute, and manage. And so last week it was all about the MA cross and the money calendar. Now, I'm going to mention the money calendar. Well, we could talk about MA cross and money calendar together with the first example that we had, because if you went and did your homework, which we said take a look and track the trades, there were 6 of them that we were discussing. Really 3, but we had 3 more, and I want to look at each of them. But there were 3 that I said I didn't think you could do based on just buying calls. We'll get to those in a moment. So with HRL and anything that we look at on the money calendar, it's kind of a multi-step process. Number 1, where's it going and how long is it going to take? And that's what we do when we look at our homework and we look back at our potential scans. This was also a 1030 buy. And then number 2, we plan our options around step 1. And we saw that Hormel was trending up, seasonally up, volatility was low, price target was 53. What's the best trade? And the best trade we looked at was simply buying the call options, the 50 calls, the HRL 50 calls for November 20th. We looked at that as a great example. And then I even showed you buying the HRL 50 call, and it was trading, we're looking at it at $1.50, and then getting it at $1.50, put a sell order in and sell half of it at double your value. That's what I like to do, to take my money off the table, right? So what has happened with Hormel in the last week? Well, it wasn't great. Hormel Foods is down. The options are down about $45, so they're down 30%, right, in the last week. They did get a bump up a little bit off this. This was actually down a little bit more, so we'll keep an eye on it. And it leads me to a question that I get a lot. Do you put stop losses on your trades? I have mental stop losses, and depending on who you use as a broker, you can put stop losses in ahead of time. where if the trade goes down to a certain amount, you can immediately have that stop loss triggered to get out. It could be a price of the option. So let's say if the option price went from $1.50 to 75 cents, maybe you get out of it then. You could also tag your stop loss to a stock price. So if a stock breaks below a crucial area of support, for instance, maybe that's an indicator to get you out, all in a course of preserving capital. All right, so when I look at this is great. Set the trade up, and you set your trade up for profit, but what happens when it goes against you? And so when it goes against me, I'm looking at it, and I've got an alert where if any of my trades drop to a value that I think is time that I'm wrong, that I want to go ahead and get out, I will have that set up and ready to go. So that was Hormel. And then, you know, what I'm going to do is I'm actually going to take a look at the stock charts. So I got my stock charts set up and ready to go. Let me type in HRL, and you can see what happened to it in the last, well, this is 100 days, but take a look at what happened in the last 5 days. Now we got a good bounce today, but in the last 5 days, we went from that $50.50 down to 40. We were down to almost 48.5, and then it came right back up, and now we're at 49.27. We were as high as 49.5 today. When the market started pulling back, Hormel pulled back too, but nowhere near as much as as some of the stocks out there. Like, let me throw a few of them out there that did pull back. Amazon, that's a pullback, guys. You know, we come down to when you look at what happened last week with Amazon, where it dropped all the way down to 31.60, and the next day bearish, and the next day bearish, and today bearish. I mean, we're gunning. We are gunning right now, and we came down and hit that double bottom at 31.60. So it's going to be very interesting to see where this ends up moving as the rest of the week kind of pans out. But for Hormel, HRL, it bucked the trend today of the stock market and moved a little bit higher. I mean, it kind of followed what was going on with tech, but it moved against tech. Maybe everyone took another look at it and said, this is Hormel. This is not social media. So that's HRL. All right. So next, let me take a look here and see the other stocks that we were looking at last week as we look at our trades. MDT we were looking at as a bullish opportunity, and let's take a look at MDT and see where this stock has gone. All right, so this one's actually gone up. All right, we were down around the 106 area. This was the day after. Okay, this was that. So if I put 6 days on there, you really get an idea of what it looked like that day. So this was the day after. It opened lower and then started to move higher, and was a 106 at Thursday morning that became a 111.5 by Monday. And today, you know, we had a little bit of a pullback here, but we're still trading above 109. Right, so nice little move there for MDT in our direction. 3M was another trade that we were looking at. Let's take a look and see what it's done. Also bullish, right? And you can see what happened here. 166 was Thursday's opening, and here we are today, 169 and change. That's good for call options, right? Royal Caribbean, yeah, we looked at RCL as well. So let's just see, you know, we touched on it. Let's see where it's at. Thursday morning opened at around below 59. Today it's trading above 60, so it's up a little bit, but got as high as 62 before pulling back today. All right, so far we've got one, you know, we got one moving against us. We've got 3 that are moving in our direction. Now let's look at the other 3 that I want to talk about. I'm going to show them to you, but you'd have been a fool to buy call options in these 3 stocks. And I said this last week. I said they're quite expensive, right? So let's take a look first at AZO. All right, this is Autozone. Autozone it opened at $1,160 a share on Thursday morning, and it traded up to as high as 1205. Today it's at 1178. Now I want to share with you something here. Let me open up another screen. I'm actually going to bring up another Tom's Option Tools chart. And the reason I'm doing this is because this is something that we can do in the tools that is actually very easy to do. So I'm going to go over here in this area that says stock date. I'm going to try to zoom in as much as I possibly can here. So here's stock date. And what I'm going to look at is I'm going to take my stock date. I'm going to bring it back to last week, to 10/14. So here we are on 10/14. Now I'm going to bring up an option chain for AZO. All right, I'll blow this up in a second, guys. So let's just throw that November 20th because we were tossing that around a lot last week. So here's our month to expiration. This is the number of strikes in that expiration date, and this is the number of days to expiration. If I scroll down, you'll see here's my call options. Right, now remember I said these are going to be expensive. The 1170s are the at the monies. They're $45.30 for the November 20th. If we were to buy one of those, first of all, it's not going to be cheap. Let's go look and see. We're talking about $4,500. How much is this worth today? AutoZone went up. Now what I can do is I can look at it on a +1 day. So here's Thursday. Boom, up 27%. Hey, Tom, you're wrong. I could have got a 27% return in 1 day. Yeah, you're right. Your $4,530 would have went up and had a $1,225 profit. All right, let's look at the next day. Wow, $13,895. I mean, if you're willing to spend that kind of money, absolutely. Now let's take a look and see what 10/19 did. This is Monday. Oh, it dropped back to $390. Let's take a look at Tuesday. Oh, no, we're at 5/10. How about today? 3/15. So I mean, you're sitting there, you've got your capital when it's up a little bit, but look what did AutoZone do? AutoZone moved. We had that big move up, stayed up, came back down, and we're kind of sitting where we were since Monday.
Hey Tom, I know you're blowing the screens up, but there's also a request for you to use the big pointer when you can.
Yeah, I thought that was going to come up. Let me see if I can actually find that without muddying up my screen any more than it already is. You know what? I think I can. Yep, I think I can. How's that, Jay? Better? Round and round she goes.
Yes, sir.
Okay.
Good.
So that's AutoZone. Let's take a look at the next one. So the next one I want to look at is Autodesk. Not at all like AutoZone. ADSK software. Let's take a look at it. And so we're just going to look at the last 5 days. ADSK. Now ADSK is also an expensive stock. Not as bad. Not anywhere near as bad as Autodesk or AutoZone, but $245 that got to as high as almost $270 has pulled back, and now it's back down to $254. Let's see what this one has done. And so we're going to go back to our stock and option table. Now what I'm going to do here is this time I'm just going to simply change the strike price or the symbol, excuse me, ADSK. And I'm going to click on update. Now we're still looking at 10/14 last week, but I'm looking at Autodesk, and I got to reset my strikes. So I don't want to look at the Oct 16s. I want to look at the November 20s. There's November 20. Let's hit update. Let's scroll down, and this is what we've got with Autodesk. So Autodesk at the time, the 250 calls were as close to at the money as possible. Those two are going to cost $11.05 or $1,105 a contract. Okay, so how did this do during the week? Let's look and see. I'm going to do a risk graph. Now these are all end of day quotes only, everyone. So we can't see the spikes up to see if they actually hit profit targets. But I mean, in a week, who knows? This one the next day was up to $323 or 29% return. Let's plus a day again. Now it's at 69% return. And this was, you can see here that this is the day it climbed up, and it tagged that area just from about a month and a half ago. Let's see what happened on the 19th. Okay. Up 73%. 20th, up, backed off, only up 52%. And then today's date brings us back to only 26%. Now I want to share something with you here. Let's go back and look at Autodesk on the chart. you see this date here, the 19th? Let's go back and look at that graph one more time. All right, now let's take ourselves back to the 19th. Minus a day, minus a day. This was the closing. When you see, oh, that's Autozone. Let me get rid of that. Autodesk, minus a day and minus one more day. So 73%, and that was 810, and that was on a stock close. That if you look at that day, the stock closed right here. It closed at 260. The high was near 270. There's a very good chance that by looking at this at the 19th, looking at the options on the 19th, that 73% could have made 100, could have had 100% return before pulling back. That's why it's important to have that, you know, to have what I had in, you know, for Hormel, sell half at double. Have that in place so that if you're out having lunch or if you're just away from your computer and it goes up there and tags that you come back and you see an order fill and you're like, all right. You know what's better than getting out of half your trade if it doubles in value when you're not around? Getting out of half your trade, it doubles in value and then it pulls back. And you say to yourself, wow, I'm so glad I put that thing in ahead of time. So that's Autodesk. The last one we were discussing was Microsoft last week. So let's take a look at Microsoft. Now to do that, I'm going to go back to stock charts. I'm going to go to MSFT. Let's see what Microsoft's been doing. So Microsoft has literally been dropping. Now, again, Thursday morning, it was at 217. Today it's at 214.80. So let's take a look at those options. So to do that, we're going to come back up to the option chain. And we're going to come on over. We're going to click on MSFT. And let's come down and let's update that. And now we're going to change those OX16, that OX16 date again to November 20th. Update. I know I'm moving fast for some of you to either don't use our software or haven't been using it that long, and I apologize. This is what I do. It's what I do every day. So I'm kind of used to clicking and moving. So I'll try to slow down a little bit.
The good thing is it's being recorded, Tom.
That's right. You can always hit pause. I'm looking at 10% above and below the stock price, and I'm looking at November 20th expiration date. If you come down, you can see here's my November 20th stock. Was this today? Let's look and see. No, this is 10/14. So 10/14, the stock was at 220.86. So the 220 calls with November, these are the ones that are the at the monies. So if I bought one of these, I'm paying over $1,000 for it. Let's go to the risk graph. All right, over $1,000. We're talking about a trade that's $1,018. That was on the 14th. How much was it on the 15th? Remember, this one dropped, guys. So it's down $75 on the 15th. 16th, now it's down $80. It's down 7.9%. The 19th, which was a Monday, down 30%. Tuesday, down 33%. And today, still down only 33%. All right, so that's today. What do we do if we drop down to below 50%? Well, have your order in place to get out. Now, if you trade this at 1,000, I mean, does it make sense to do, Jay, and I'll ask you, does it make sense to do one contract of Microsoft and one contract of RCL, one contract of Autodesk, one contract of MDT, MMM, AZO? Does it make sense to do one contract of each when you're buying calls? I put Jay on the spot.
What's that?
I put Jay on the spot.
Yeah.
It's because he's answering questions in the background. He wasn't listening to me. So let me give you guys the answer. The answer is no. You might think, oh yeah, I don't want to do 20 contracts of Microsoft and only one contract of NDT. That overweights one and underweights the other. But do you realize by doing one of each of these, you could be overweighting one and underweighting the other simply because of the cost of each trade? This was $1,000, okay? I'm sure 3M and MDT cost a lot less. So that's why what I do is I look and determine how many dollars do I want to risk? And if it's $1,000, I'll buy $1,000 in Microsoft calls, 1,000 in RCL, 1,000 Autodesk, etc. So I'm dollar cost averaging when I go in, and I risk a percentage of my account, of my options trading account, on particular option trades. Now, if you use a number like 500 or whatever, you can't do the Microsoft call, you can't do the Autodesk call, you can't do the AZO because they're too expensive. And that's what I want to talk about with the next topic. So, Jay, before I move on, are there any questions that you might have that we might want to ask and answer?
Yeah, the biggest one is just basically where did they find the recording from last week, and I'm letting them know.
Okay.
It's posted
YouTube.
on your YouTube channel.
We put it on the YouTube channel this time, guys. Everybody can find it. YouTube.com/Tom's Trading Room.
I'll put it in the chat box.
Awesome. And I sent it out to everyone last week too. So you can always check the email from last Thursday. If you got an email from me last Thursday on Tom's Trading Essentials, and it should say something like the recording, click here. There was no password to watch this recording. Okay, so moving on. Let's talk about trading spreads. So spreads are very similar to buying calls. It's just that, when you look at that Autodesk trade or AZO, let's bring that one up, because AZO, we're going to use that as a live example. So here's AZO once again. Now, we're going to use today's prices today. So I'm going to go to the stock and option table, and I'm going to set it up real quick. But the first thing I want to do is I want to update myself to today's date. I also want to put in AZO because that's the one we're going to be looking at. And we'll leave it at this because we're going to come back and we're going to fill in all the blanks in just a moment. All right, so back to the stock chart. We already know AutoZone's expensive. This thing's trading at $1,178, okay? And so for stocks that are expensive like this, it makes sense to spread your risk. And that's what a spread is. A spread is a way of simultaneously buying an option and selling an option and taking the spread price in between. And we look to profit by the spread price widening. Right? So a bull call spread is what involves call options. And that means we're buying a lower strike call, selling a higher strike call, and that lowers your overall cost of your trade. It lowers the overall risk of the trade, and it also lowers our fluctuation back and forth on the trade. Okay? So that equals lower stress. All right? So especially in times like now. So if you take a look at an example, this is a static example for educational purposes. Buying a lower strike 100 call, selling a higher strike 120 call. Let's say we paid 10 for the lower, and then we sold the higher strike for 5. So we paid out 10, but we took in 5, so our net debit is $5. Now remember, this is a 20-point spread. We just paid 5 for a 20-point spread. That 5 times 100 shares for the contract means that this trade is going to cost me $500. This is also referred to as buying the XYZ 100-120 call spread. That's what that means. All right. Moving on. Now, this is an example of a risk graph. When you put all of that together, what is the risk? What is the reward? What is the break even on this spread? So if I own I bought the XYZ 100-120 call spread for 5, that means I have the right to buy XYZ at 100. That's the call option I bought. I am obligated to sell. That's the assignment. All right, I'm obligated to sell XYZ at 120. So if I exercise at 100 and I get assigned at 120, I am basically buying at 100 and selling at 120. I get a $20 move in my favor. If I paid $5 for that 20-point spread, then $1,500 is my maximum profit potential. So to remember, risk is what you paid for the spread itself. You can risk no more than $5 on the trade up to expiration. The reward is you take the difference between strikes. 120 minus 100 is 20 minus the cost of the spread, and that gives you your maximum reward at or above the sell strike. Your break even is easy to come up with too. See this 105? All you do is you take the 100, the buy strike, and then you add the spread cost to it. So 100 plus 5 is 105. Risk, max risk, at or below 100, max reward, at or above 120, break even. That's going to be buy strike plus spread. All of these numbers are reflected at expiration. Now, let's look at 3 different traders, all bullish on XYZ, but each one does something different. We'll look at risks and rewards on those. The first is that the stock goes from 100 to 120. Now, you got Trader A who buys 100 shares of stock for $100. Right? Trader A paid $10,000 for that 100 share of stock. That means that that's his risk. His reward, now 2,000 is that it goes from 100 to 120. So what's that open position reward? That's $2,000. That represents a 20% return on investment if the stock's trading currently at 120. If Trader B buys a call option and pays $10 for that call, remember the 100 call costs 10. That's $1,000 cost and risk. But if the stock goes to 120, that 100 call is worth a minimum of 20 points. If you paid 10 for it, you're up 10. If you paid $1,000, your $1,000 is worth 2. You now have $1,000 profit or a 100% return on risk. Trader C buys the 100-120 call spread for 5. That means they paid $500. At 20, this could theoretically be worth $1,500. That is a 300% reward to risk ratio, 3 times the risk. 1 times the risk, 0.2 times the cost and risk. That's what if I'm right? What if I'm wrong? Stock goes from 100 to 50. Well, Trader A, who bought 100 shares for 100, even though their total risk is 10,000, right now they're at a $5,000 loss. Trader B, who bought the $10 call, could be worthless. Trader B lost $1,000. Trader C, who bought the spread, the 100-120 call spread, well, that too could be worthless. But remember, what he paid for on the calls that purchased, that was the 100 calls. He sold on the call on the 120 calls. Well, he took all that in, so that total risk and total loss is $5. So when you look at it, B and C lost all their money. A only lost half of his or her money. But when you look at the dollar amounts, the silver lining is that on a 100 share to one contract spread, Trader C has the silver lining, right? Buy the lower, sell the higher. Put spreads are like call spreads. They're used in bearish opportunities when options are expensive. Only difference is you buy the higher strike put and sell the lower strike put to create a put debit spread, right? And then it too has lower cost, higher reward, and a higher profit potential. Now I'll tell you what my differences between call spreads and put spreads right now. Put spreads, if you're bearish and the market's moving in your direction, you're typically going to want something that has a little bit less time to expiration. So for instance, if you kind of subscribe to that theory for the stock market, stock market makes 2 steps up and 1 step back, or 3 steps up and 2 steps back. Think of this. The bull takes the stairs. The bear takes the elevator, or the bear falls down. Falling happens much faster than rising. And so you don't need the same amount of time if you're right on the market dropping. Look what happened back in February and March. Market dropped hard very quickly. We lost 33% of the value of the S&P 500 in a month. So it took many months to gain that 33%. It was all lost in 1 month, and now it's come back. Bull takes the stairs, bear takes the elevator. Now remember these 3 stocks, because I want to go back and I want to look at them, but I want to look at them in spreads, spread opportunities. Now AZO, and forgive me, but let's go ahead and let's go over and look at money calendar. because I believe money counters where we got these 3 particular trades, but let's see where they are today, right? So there's Autodesk right off the bat. I'm just going to hit the power meter. There's AZO, there's Autodesk. Where's the other one at? Where's Microsoft? Is it in here? I'm looking. Jay, if you see it, just shout it out. Microsoft may have come off this list, or maybe I just slid by too fast and didn't see it. There's Intel. No, I don't see it on there. Okay, so let's work with the 2 of these for now. I think maybe Microsoft was at 1030.
Either that or just hit symbol and see if you can alphabetize it and find it that way.
You know what? We could do it that way. Let's see. M. M is for Microsoft, and M is for nope, not Microsoft. All right, so what we could do is we could go back and look at the actual app, but we'll do that in a moment. So AZO is showing going all the way out to November 26th, and you know, a November 20th option's not bad for this because you know, it's going to have a better it's going to have more liquidity and better slippage. Most options contracts trade, the most liquid option contracts are always on the 3rd Fridays of each month. So if you'd used the November 20th, you can always roll out, right? And you know, go further out if you need more time. Now, what this would look like is, let's go to AZO, and I get rid of that. So AZO, let's update that with a November 20th option. And we're going to look at, now, what else do we want to look at, Jay? Well, we know how long it's going to take to get there. And we're looking at about a 50-point move. I mean, even more than that. I mean, more recently, it's like 175 to 100-point move. So let's use a 100-point move because AZO is so much more expensive than it was 10 years ago. 10 years ago, this stock was a $260 stock. Last year, it was $1,180, and it was moving 75 points. Right, so where is it at now? Well, it is right back at close to 1180. So we can utilize the numbers we have right now, and we can say, all right, well, if it's 75 points, that would take us out to about 1250, roughly. So we could take the 1250 call, and that's our target. What I always do is I look for the target first, and then I work my way back down, and I try to find a spread that's going to cost me $500 or less. So 15. Then I'm going to try to find something that's 20. So 15, well, to do the 2140, it's going to cost me a little bit more. It's going to cost me like $6 to do that one. Let's just take a look at that one real quick. So I'm buying the AZO 1230 call, and I'm selling the AZO 1250 call for November 20th. What's that going to look like on a risk graph? Let's find out. Here we go, $620. But can make a possible 1380. That's a 222.5% return on your investment, taking it all the way out to November 20th. Now, this is what the risk graph looks like. Again, your risk is if AZO drops. It doesn't matter how far it drops, but if it drops down, the most you can lose is what you put into the actual spread. But if AZO goes up and it gets, let's say it gets up here into this area that was, you know, just a month or so ago, you come over and you can see that it's already hitting max profit if it gets up there by November. So that's in the 1300 range. So this risk graph just gives you an idea of what you stand to make or lose with this stock moving around. This is the stock on the left. This is the option trade on the right. All right, so that's Autozone. So what we've done so far is looking at Autozone, we took, instead of buying the call, the 1230 calls and paying $21 for them, we were able to hedge our risk off by nearly 4, by a factor of 3.5. All right, so you've gotten rid of over 75 or 70% of your risk by simply doing the spread. Now, what if we were to, let's do this instead. Let's go back down to those Autozone. And remember, I was long the 1230 and short the 1250. What if we were long the 1240, short the 1250? This is a 10-point spread. What's it going to cost me? I can only make up to 10 points minus what I got in the trade. All right, so this was 285 to make $715. That's because you're buying it at 1805, you're selling it at 1520, and then this is your reward to risk ratio right here. So you can see that the most I can lose is what I put into the trade, but then I can make as much as 250% reward to risk. So this one really does have a lot less risk and could make 3 times or 2.5 times the reward. Again, that's the November 1240, 1250 call spread, buying the 1240s and selling the 1250s. That was Autozone. Let's take a look at Autodesk. So Autodesk, I'm going to change. I'm going to come on over and we're going to type in ADSK, Autodesk, update. November 20th. Oh, let's go to Money Calendar real quick and look at Autodesk. So go back to View Day, and then I'm just going to double click my power meter. Here's Autodesk. Autodesk, again, is also one that takes us out to November 27th. Look what it did last year. Had a big move up, but prior to that was only about a 10-point move. Then it jumped up to almost 40. So we could take a look and wait in what this did last year, because this stock's no longer 140 going to 180. This stock's 200. So I would look at that 40-point move as a potential target. So we take a look at ADSK, and I'm going to bring up ADSK right now. Update to November 20th, $254. Let's look at, well, you know what, 275 is, goes all the way out to November 20th. So 275's well within our target, because we're only looking at about 30 points here. All right, some 54, 64, 74, 20 points. 20 points, well within the target. If we sold the 275s for 425, now again, add 5 to that, and you're talking about 925. So go up the scale. There we go, the 260s. So if I bought the 260s, do you guys see what I just did? What I did was I took the 425 that I have in, and if I want to pay $500 for the spread, you add 5 to 425 and make sure you're not buying anything for more than 925. 260s are 913. 260, 275, that's a 15-point spread, right? So I already know I'm going to get a 2-to-1 on this one, because if I'm paying $5 for a 15-point spread, there you go, 207% reward to risk on the trade. This is buying a 260 call, selling a 275 call, November 20th. And again, you say, oh, what about the 27th, Tom? Okay, so let's go see if they have 27s. They do have 27s. Let's just take a look at the 27s, and let's see what they offer. 275s are 623. So let's put a -1 there. All right, count them off with me. Start at 6, so 7, 8, 9, 10, 11, so that's 5. So I need to find nothing more than $11.23. All right, well, 262 halves are 10.50. Look at the 260s, they're 11.58. I mean, you could do that. You're going to pay a little more than $500 for this spread. And keep in mind, it's going to have a little more slippage. That's why it costs a little bit more. But $535, 180% reward to risk. You're still buying the 260s and selling 275s, but you're doing the November 27th expiration date. Isn't November 27th, isn't that Black Friday? I believe Thanksgiving is the day prior. So keep in mind, you're going to lose a day. So what is 4 days? But I'll let you know this too. Typically going into the Thanksgiving holiday season, and I'm talking about that week, the Wednesday before Thanksgiving and the Friday after Thanksgiving, typically bullish. We don't know what sales are going to be on Friday. We don't know until the following weekend how well sales were. And so everyone expects, and leads up to sales, and that hype can cause the market to move in our favor. Okay.
A couple of questions when you have the time, Tom. On
absolutely, let's hear them.
Okay. Javier is asking, how do you know or how do you guess the prices to choose? And Grace is asking a variation of that as to why a $15 spread. Okay,
so once again, first what I like to do is, and what I'm using for my my target is I'm using Money Calendar, and I'm using the what I get called a target price based on what's happened in the past. So during this time frame last year, this thing moved up almost 40 points, $38.88. So I'm using that, and then I looked at the last couple of years too. So I came up with an estimate of around 30 points in my head. You want to have some sort of reason. Your reasoning isn't because I think it's going higher. And to both of you who asked that question, I know that's not what you're thinking. You're not saying I think it's going higher. You want a real reason. My real reason is I use an objective trading strategy like Money Calendar, and what I'm doing is I'm going back in the past 10, 20 years, and I'm looking at what it's done in the last 10 or 20 years. If it's not on this list, I'm not even looking at it for this particular strategy. It needs to be on this list. 9 out of the last 10 years has gone higher. What's the average it's gone up? What's the weighting? What did it do last year? What has it done lately? And I use that information to come up with a target price based off of where it is today. I add that to that target. This area here tells me how long it might take for me to get there, because it's given me, again, the best time to buy and the best time to sell. All right. I'm sitting here watching, I got my phone on too. And so my Coinbase accounts just can lighten up. Bitcoin Cash is up 10% now. I mean, every few minutes it keeps dotting on me and telling me what's up and what's going up over in the world of cryptocurrency. But I hope that answers the question. Is that we have a target price based on, and a target time based on utilizing the Money Calendar here, right? So that is spreads, and I can do the same thing. Let's do one more with Microsoft. So I'm going to take a few minutes and I'm going to move a little quicker here. But let's pop on over. First of all, let's find out if Microsoft even looks good now. If we were going to take the trade today. So I'm going to actually go in here. I'm going to type in MSFT. And there it is, right down. I rolled right past it. Where is that? Where did it go? MSFT. There we are. Microsoft, show me. Ooh, there's a 100%er. A lot of these start tomorrow. Okay, so 100% trade on Microsoft. And here's what we're going to do. What is the ending date? Right there, November 27th, of course. What's our net profit? Okay, what's our average trade profit? Just shy of $5, right? But if I look at what happened last year, $14.93. I have to weight that in somehow. So let's take that and then the average, and we'll come up with a 10-point. We're going to come up with a 10-point target. All right, so 10-point target by November 27th. How do we do this? First, we go put up Microsoft, MSFT. Let's update. Let's go look at November 27th, because that's our date that we want to be looking at the options. And then I just got to make myself go, I just got to look at the strikes that are 10 points higher than where we are today. So if we're at, let's call it 215, I need to be looking at the 225s. The 225s are $5.48. We're going to sell those because that's the target. I'm going to buy a lower strike. Where's my lower strike? The 215s are $9.65. The 220s are $7.28. Let's just look at the 220s. We're going to make a cheaper trade right here with Microsoft. So buying the 220 call and selling the 225 call, it looks like we're going to be able to do that for a little less than $3. Let's check the risk graph. Wow, a lot less than $3. $1.80 or $180 to make a possible 320. So that is a 177% reward to risk ratio. The worst you can lose is 180. The best you can make is 320. What are we doing again? Buying the 220, selling the 225. All right, the 225 puts money in my pocket. The 220 costs me money. The difference is the spread. What's it look like? 37-day trade. Let's bring that down a little bit more. There's your stock price over here. If we get back up to 233, bingo, then we have a trade that has profitability. All right, even if we get up to the 225 area that we was at just last week, you have maximum profit potential. All right, again, buying the lower strike, selling the higher strike. Now let's move into a new category here outside of Money Calendar. I want to talk about triple stack compression patterns, or what I also like to talk about, which is channel overlays. Darknet is a strategy that our programmers have put together several years ago. It was on the cover of Stocks and Commodities magazine several years ago, and they did a review of it, and they actually really loved it. And so I want to share with you a little bit of what this does, right? What type of trading strategy this is, because this is not seasonal at all. This is a technical trading pattern. It's very similar to Elliott Wave. So any of you to know what the Elliott Wave strategy is, then you'll kind of get an idea what this is. I'll tell you where it differs. But Darknet is similar to Elliott Wave. It's a contrarian trading strategy. We use channels, and as these channels all short, intermediate, and long-term channels all consolidate, we get our buy signals. Now, where it differs from Elliott Wave is that the signals stay where they are, win, lose, or draw. They don't change. They don't flop around. Like an Elliott Wave, if you've ever followed Elliott Wave, it's always changing unless it's right. If it's wrong, it always changes. Darknet's a buying only strategy. What that means is that we've determined through several years of backtesting that the contrarian bullish signals are much, much better than the bearish signals. And let me show you what we're talking about here. So this is an example of what collision will look like on your screen. You have a longer term trend. What happened to my, there we go. You have that longer term uptrend. You have the intermediate term pause, and you have the short term pullback, and they're all happening right around support on these three channels, and that's what's called channel collision. The software sees it like this, and what we can also do is go back in time and see, well, where were the past signals and how did they do? So on this particular stock, buying at 43.5, selling at 44, buying at 42.5, selling at 45, and then of course current signal. Okay, we get these in the form of multiple scans. And I can take a look and see all kinds of stuff that's going on. And then what we'll do is we'll rank them. And we look at them sometimes by slippage. We'll look at them by implied volatility. That's that option rank. The delta, which means how fast the option will move versus the stock. And the most important category is the percent to double. How much does the stock need to move in order for the trade to double in value? Lower is better here. The lower the stock, the less the stock has to move for the option trade to double, the more I like it, right? So let's look at some case studies today. And we're going to actually bring up Darknet from today. So in order to do that, I'm going to come over here. I'm going to bring up my Darknet home. Let's go ahead and update this to the most current data. There we go. And what you'll see is that we have actually, we can have up to 3 different signals on a stock, right? Now, typically, I like signals that are buys or rebuys, and I'll explain what those are. These that you see on top, right here, starting with RPT and going to Exxon, these are all bullish signals. The ones in the second list, starting with CRK and going to PAA, those are stops. We'll take a look at, let's start with the stops, all right? I want to show you the stops because you'll get an idea of what these things did from beginning to end. This was Comstock. Comstock had a buy at $4.75. It just sold today, and that was at above 550. Nice move when you take a look at the percentage move on the stock. How about energy? NRG Energy. Look at that beautiful buy down there at the bottom, and that was at below 28.5. And the sell came right here at around 33. So that was 28 to 33, a 5-point move on a $28 stock, and the options fared even better. COG, Cabot Oil and Gas, that one did not buy the bottom. It bought the day after, and it sold today. All of these are sells today, by the way. Sempra Energy, a buy at 123, a rebuy, that's the second signal, at below 118, and the sell came at 130. Great, great moves. Comtech, this was a buy at 14.5 and a sell at 16.5. CIG, buy just above 180. Yeah, and there's some pretty low dollar stocks in here too. I mean, I wouldn't even buy an option on this stock. This is a stock to buy and then sell. And then the sell came at 2. KEX. Now, Now we're getting into the end of the run here, so we'll tell you what we're talking about here. So KEX had 3 signals. It had a buy at 45, it had a rebuy at 43, and it had a final add-on, the third and final buy at 36. The sell came at 40. So the 36 to 40 made money. The 40 to 42 and a half and the 40 to 4 and a half lost money. So you can see that it does have an average in on some of the trades, but it's not an average. It's only if we hit channel consolidation again after the first, and in this case, the first and second signals. FFIV, buy at around 134, rebuy down here at 120, sell at 130. So that one could be, call that a break even. Loser on the buy, but a winner on the rebuy. SEF. This one had a lot of buys and sell signals in the past. They worked out really well. This one did too. I mean, the buy was at 18.5 and the sell was at $18 and let's call it 67 cents. All right, so 17 whole cents, but a winner's a winner, even though it's not much in this case. KAMN, buy at 42, sell. Let's call it 42 to 43. And PAA, that's Plains All American, buy at 675, rebuy at 675, sell at 650, loss. When you add all these up, long term, this has been working out really well. It does have losses. There's nothing out there that doesn't, but it's something that you might want to look at as a contrarian-based strategy. Has done really well for the month of October, the month of October, and I told you guys this last month, you know, and I mentioned this in a video not too long ago, at the beginning of October, that October is typically, you know, everybody is worried about October. I'll lose all my money in October. No. If you were back in the days of 1987, that might be correct. But over the last 20 years, October has been more of a bullish month than a bearish. Okay, now I'm going to take this, I'm going to change this around a little bit here so we can see the call option trades. So in order to do that, let me just redo a search here real quick. We're going to look at potential call option trades. And out of all these stocks up here, it shows me that 5 of them qualify in the call option category. They all have great slippage. All right, slippage, if it's below 1.0, I like it. But look at AT&T. AT&T has the lowest percent to double. So let's take a look at AT&T. If we look at T on the graph, what we'll find is, let's just open up a chart, and you can see here, buy, sell, little loss, and a buy right down here in the low 20s. I find it interesting that this has been dropping and really been dropping ever since the iPhone 5G got announced, because you know what's been happening? All the competitors are running out there trying to get their own 5G plan, because AT&T was offering $800 on a trade-in on your old iPhone, and the others were offering $400. Well, guess what they did? They decided to, you know, it's a race to the bottom is what's going on with telecommunications companies. But AT&T pays a nice dividend. It's a long-term, it's a great long-term trade. It's got earnings tomorrow, all right? But again, it's dropped down quite a bit. So we'll see where it ends up at. But you can see here that this is the November 13's 26 calls. November 13, 23 days to expiration, $1.22 or $122 for the trade. Right? Where are we on our break even? Well, if we get above 27.22 by November 13th, that's your upside break even. Downside break even too, since you're just buying a call option. This is an example of a trade. Again, how do we come up with this? Well, Darknet came up with it with that triple stack compression, where we're seeing long, short, and intermediate term channels colliding down here at the levels we see today. Right, so that's AT&T. Let's go back and take a look and see what else is out there. I saw Realty Income in here, I think. Yeah, Realty Income 0. O is the symbol, not 0. O. Realty Income has a 7.57% return to double. That's a November 20th option. Let's take a look at the chart real quick. You'll see here that their earnings are in 12 days. Now, Realty Income, I don't see any other Darknet trade on the chart except for what we see today. Now it's come down, it's created some support levels right here at this area, so this might be a good area to be a buyer. And if we look at the options, the 57.5 calls are going for $3.35 or $335 for the call. Again, we got to be above 60.85 for break even, and to get a double means that this 335 has to turn into $6.70. Add that to 57.5, and that's where the stock's got to be for you to potentially double in value. That's the November 20th 57.5 calls. Let's look at one more. Back to Darknet again. I've got so many pages that are stacking up here. I'm going to leave them up here, but you've got BHP and you've got CMP and AGO. I'm going to have to go with BHP because it's number 3 on the list. They all three have great slippage. That means the bid-ask spreads are very close together. The IV rank on BHP looks fantastic at 7.5, and 798. I mean, you know, it's close to the second pick. So let's take a look at it. November 20th, 50 calls, $2.72 or $272.50 for the call option, and that shows a $52.73 again upside break even by expiration. What do all three of these have in common? Well, nothing really when you look at where they are in terms of their sector. This is copper, all right. BHP is copper. O, Realty Income is miscellaneous investing, and AT&T is telecommunication services. So they got nothing in common there, but you know what they have in common? They're all hitting Darknet buys. They're all hitting what we call that consolidation, channel consolidation that's happening. Okay, so that's Darknet, and you know, I would urge you to check this out if you guys have if you have access to our software. Okay, if you don't, if you're here for the first time tonight, you missed last week and you wanted last week's recording, you know where to get it. But also, I will give you out in just a few minutes a link if you've never used our software before for 2 free weeks of anything. All right, any of our packages, which is the option trader package, the contrarian trader package, which is what this is in, and the complete trader package has everything, including money calendar. All right. Jay, any questions?
The biggest question that came in before you even kicked into Darknet, Tom, was what do you do with earnings? There was one example you gave that had an October 27th earnings. Somebody's asking about how do you trade earnings around Darknet. My answer was, unless you want to take it in full, I'll leave it at that.
Please.
The answer is, guys, the earnings may not deter us from taking the trade, but it does act as a time stop for us once we're in a trade. We don't like to hold trades over an earnings announcement. So if you're going to get into a trade based off any of these scans and these tools, even though there's an earnings date out there, you can still entertain the trade, but just know that you don't want to hold this over earnings. So whatever the earnings date is, you want to be out by at least the day before.
Yeah, so like AT&T, for instance, which earnings are tomorrow, maybe you might want to wait till after tomorrow, because you know why? I'm going to show you one more thing, and this is really the biggest reason why. So I'm just going to go bring up a stock chart. And let's take a look at AT&T one more time. And here's T. All right, but I don't want to look at this part of T. I want to look at the last, let's say 60 days. That's 3 months. Now, take a look at this implied volatility chart. AT&T is going down, great. So if you're bullish on this, that's fantastic. Maybe you'll catch a falling knife here, or in this case, a falling Darknet buy. But the part that I want to make sure you're aware of is look at this big jump up in implied volatility. This thing was trading down at 16. Now the options are trading double what they were. If you wait a day, regardless of which way this thing moves, that IV number is going to drop really hard. And you could end up getting the options a lot cheaper after tomorrow. Okay, so I'll just leave it at that with the earnings. But Jay, you're absolutely right. Unless your strategy is going through earnings, I stay away from earnings.
And then the last one, if you want to address as you wrap up for tonight, Tom, is your views on what the election could do to the markets.
Oh boy.
We have a
Well,
report.
I mean, you know what? My opinions are about as good as anybody's, so I'll let you know that right now, guys. I mean, maybe I draw a little bit more conclusions with data. What I can tell you is that data in the past tells us it doesn't really matter whether Republican or Democrat controls Congress over the long term, but over the short term, I expect to see some volatility. So let's think about in terms of probabilities. The probability that Donald Trump will be reelected or the probability that Joe Biden will be elected, I mean, depends on what channel you're watching. All right, if it's CNN, there's 100% probability Joe Biden's going to be president. If it's Fox News, then there's 100% probability that Donald Trump's going to be president. I want to say I think that we're right down the middle, 50-50. I don't even trust the polls. So it's going to be a tight race. Now, let's come up with some outcomes. If Joe Biden becomes president, if Donald Trump becomes president, I think the market pops on the news. But then I do think we have to deal with the ever impending sell that news, buy the news and sell, days after. If Joe Biden becomes president, I think the market's going to drop. And I do think we're still going to move down because there's just been such a move up. And I'm looking at these stocks like, you can't help but look at Zoom Communications. Let's just look at that for a second. ZM. These guys are doing their best just to hold this thing together. Because if you look at it in the last 200 days. Last year, the stock was trading at $75 a share. It just came off of almost 600 before, this is the melt up that's happening over at Zoom. Now, do I believe that Zoom video communications is here to stay and that this isn't just some, that this virus is, once we have a vaccine, everybody's going to go back to work in their corporate offices? No, I think this is the new norm. But I also think there's got to be some sort of correction that happens with Zoom. And it looks like the last couple of days, it's been starting. It's kind of like Beyond Meat. Remember Beyond Meat, BYND? Take a look at Beyond Meat, ND, and you get a good idea of what happens with this stock. Here's one that ran up and then it auto-corrected. Now it's ran up again. Now it looks like it's auto-correcting again because, we're talking about multipliers that are just many, many more times than what averages should suggest. But here's the big but. The US dollar, if we continue to print, if we continue to be in an area where we have very little, if any, interest rate, very low interest rates, where else can you put your money? That's what's holding a lot of these stock prices up very high. So if there is a correction, I'm not looking for us to drop back down the pre-coronavirus lows simply because the money out there, money's free right now. It's not free if you got a mortgage, but it's literally free compared to what it was. And so businesses are taking advantage of that. Now, what do I think is a better alternative coming out of the election, regardless of who wins? Regardless of who wins, they're still going to have to deal with stimulus. If the Speaker of the House is holding off on stimulus till after the election, they're going to have to release the stimulus after the election, regardless of who the president is, because the American people need it. So when I look at something like a GLD, all right, and I see this thing jumping off of 195 and pulling back, but really holding its ground very well because this has been moving around with stimulus. And as GLD, you get into that look at the last 50 days. That really just kind of tells you, you see that move down, but we're bottoming around 174 and now starting to climb again. This is all climbing on stimulus hopes. Once that stimulus comes through, this should, as economics 101 dictate, dollar goes down, everything else that a dollar buys goes higher, right? So that's GLD. I think that's also the reason why, you look at Bitcoin, you say, okay, yeah, PayPal. Okay, well, PayPal's doing this, everyone else is going to jump on board and start looking at this idea too. And so, if I go over and I look at crypto tools, I think cryptocurrency, and I also believe that, something like a hard asset like GLD or the ETF GLD is going to be very beneficial in the long term. Here's BTC. Here's a chart of Bitcoin. Look at what just happened in just the last 24 hours. All right, this is today's price, and that's the after 5 o'clock price. This was today also. So you see that big move higher? All right, Wednesday, Tuesday, Monday. We were at 11,500 below that coming into the weekend. We shot right back up, and we traded above 13,000, and we're closing in on 13 again. Because I think what's going to happen is you're going to start seeing more and more companies kind of piling into Bitcoin because they realize that it works for them. Now, a couple other things before I sign off for tonight, guys. Number one, Darknet and Money Calendar. We now have apps. We now have trading apps for those. So any of you that sign up for our software, first of all, you're going to get the if you sign up for the contrarian, or excuse me, if you sign up for the option trader package, we're going to also include the microcurrency. That's our cryptocurrency app, because we have a cryptocurrency app right now that's showing our signals on all things crypto. But if you plan on getting into Darknet, we have Darknet updates, which include an app for Darknet, which we're offering up to the folks that take the contrarian package. And if you get the complete trader package, you get the microcurrency app, you get the Darknet app, and you get the money calendar app included. Okay, so I want to make sure that I mention that. These will work on any Apple and Android device, smartphone or tablet. Right, we have them working on both. Jay, final thoughts before I finish up.
That was a real clean way to end it. No, I think we're good across the board here on the questions, so thank you.
Awesome. All right, guys. Again, we got case studies we discussed tonight. We're going to follow those up again next week with you. Okay. Also, once again, check out our YouTube channel. That's youtube.com/Tom's Trading Room, all one word. Okay, there's a / in there too. That's for more free education, and of course to get the recording. I'm going to put tonight's recording, just like I did last week, up on our YouTube channel. Okay, and then also for new subscribers, we have that 2-week free trial right here. You know what I'm going to do? I'm actually going to do. Last week I screwed it up. This week I'm going to make it very easy. I'm just going to cut. I'm going to copy it. I'm going to bring this back up, and I'm going to go in the chat box right now for those of you that are live, and I'm going to paste it in there. If you click on that, did it not do it? I see latest on video on Bitcoin. Did I do that? I certainly did do that. I love this live stuff, don't you? Let's try that one more time. Yeah, there we go. Got it that time. 3 times the charm. Tom'sOptionTools.com/Tom'sEssentials.htm. Click on that, and that's going to bring you to a essentials page. And here's a terms of service. Read this. If you click I agree, it's going to take you to the PayPal link. And remember, you won't be charged during the 2-week free trial. So your 2-week free trial starts, and you can immediately upon signing up, and the option trader and all the stuff that you get there, including the microcurrency app, the contrarian trader and everything you get there. And basically, the contrarian trader is all of option trader plus information for contrarian, and complete is everything. And that's option, contrarian, complete, which includes the money calendar, all the apps, the dark money calendar, Darknet, microcurrency app, and hundreds of videos. It is 100 plus now, hundreds of videos. All right, guys, so there you go. Thank you all very much. I see all your comments, guys. Thank you very much. If I sat here and commented on every comment, we'd be here another hour. So let me just say this. Thanks to all of you. Oh, hey, by the way, I got to mention this too, Jay. So we started a merchandise site. You know, someone was asking, hey, how do I get that Tom's Trading Room shirt or hat or whatever? So at YouTube, below the YouTube videos, you can see the merch site. All right. Do you know what people are buying on the merch site, Jay? Masks. And by the way, I'm not in the retail business. I actually
Yeah,
cut
if
these.
not for current use, but for nostalgia's sake as well, right?
Exactly. Yeah, yeah. But I mean, and guys, I mean, we cut our prices down on these things to just basically, cost. And there's a code in there for free shipping too. I think if you type in the word TTR free in the code, you get free shipping as well. So we reduced the cost down because, I mean, it's literally what it's costing us to put it together with the shipping. So we put the shipping free. So check it out. There's some great little goodies there. Coffee mugs, phone, cases. I got a TTR phone case now on my phone. Got my mask. Everybody asks me, goes, "What's TTR?" when I'm moving around. I'm the only guy in town with this thing on. So if you see me, if you see a guy with a TTR thing in Florida, I'll be in Miami here sometime next weekend with the mask on. It's probably me. So anyway, guys. Thank
Hey,
you all
Tom.
so much. Have a great rest of your evening. We'll have the recording up to you tomorrow, and we'll see you again next week. We got a special guest with us. Don't miss it. Have a good night, everyone.